The Dow is moving back towards the lows of the day. All 30 Dow stocks are now in the red, and the Dow's gains for the year are gone. A distant memory. The S&P 500 has fallen into correction. That's a drop of 10% or more from recent highs. All sectors, and this is key, are in the red at this moment, and the Nasdaq is now at a 7-month low. Look at the CNN Business Fear and Greed Index. Yeah, I know you don't want to see it. We got to give it to you. It measures volatility, momentum, and demand for safe havens. It's pointing to extreme fear. Alison Kosick is assessing the damage at the stock exchange. It's pretty much fear and loathing. I think a lot of people, Alison, are wondering, has the market talked itself into this kind of a slip? The issue is, yes, we see slowing growth into next year, but there really is nothing else in the immediate horizon. Is there? What are we all missing?
Well, I mean, there's negative news about tech stocks. I mean, you think about Facebook. There's negative news about how Facebook has handled the 2016 presidential election. You know, what happened with Facebook with that. And then you look at Apple, the news about its marquee product, iPhones, which means, you know, we're seeing soft sales there. So there is real hard news there driving these tech, these big tech names lower. But what's interesting is that, you know, you look at these tech names, they're the drivers that propelled the markets higher into those record highs that we talked about almost month after month so far this year. And they're the ones that are obviously dragging the market lower now. So there's a lot of negativity in the market. I can see a lot of glum faces here. I can't remember the last time during a holiday season I've seen the markets turn into red for the year. Now, we've still got a good month and a half to go before the end of the year, but it's really been a long time since we've seen the major indices turn to the negative. We're seeing that talk turn negative too. You know, 2018, 2019 were supposed to be strong years for the economy. Now we're seeing analysts tweak their opinions and say, no, maybe that recession that we've been talking about could be coming in 2020. It could be coming in 2019 because many analysts are seeing a global slowdown begin. Paula?
Yeah, it's interesting, all that negativity, like you said. I was just there. Doesn't seem very festive at the market today, and we are heading into some very low volume, which also means more volatility. Alison, thanks so much. Now, we want to do a deep dive on some of these sectors. Tech shares are off, as Alison was saying, but they were off the lows of the day. The Nasdaq, though, is still below 7,000, and Goldman Sachs has lowered its price target on Apple, and that is significant in terms of drawing down tech. Second, retail shares of Target and Kohl's are down sharply. That's after earnings. Despite that, Target CEO insists there's no sign Americans are shopping less. And, of course, energy. Those shares have tanked right along with those oil prices. U.S. crude is down nearly 7% for the day. Hanging over all of this, let's talk about those big picture macro factors. Fears of an economic slowdown, the end of benefits from that colossal Republican corporate tax cut, higher interest rates, and, of course, tariffs still looming. Navigating the market downturn takes an incredible amount of skill. We have two experts to help guide us. Ben Phillips is Chief Investment Officer at Event Shares, and of course, our own Julia Chatterley. Yeah, like, take a deep breath, exhale. We all wanted to be having, you know, chocolates at the stock exchange today. There was none of that going on. Ben, I had certain people tell me, look, no one should panic. This is not a bear market. What do you think?
Well, the average drawdown we've seen, I think, since 1930 has been a 14% peak to trough drawdown. So this isn't abnormal to see. We're not even at 10% yet in the S&P. Now, the Qs, the technology stocks, are seeing more of that. People say they've officially entered bear market territory. But this right now, overall, is a normal market correction, normal pullback that we see. You
know, Julia, you've spoken to dozens of market experts. Literally, it must be a record by now in terms of what you've been hearing. When you've pulled it all together, are there fears? There are so many buyers on the sidelines right now. They're not piling in. Why not?
I've heard a lot of people say, look, we have to think about cash as an asset class now for the first time in a long time. And I agree with what you're saying, Ben, as well about, you know, this is a healthy correction. And with the talk has transitioned, I think, from it being a healthy correction to people saying, look, almost half the shares out there now are in bear market territory. And if you don't have the big tech names as the leaders here, what lifts us higher? And I think that's a valid argument here too, in addition to all the concerns you made. I mean, other people point at a Federal Reserve rate hike in December and say that's really going to be a kicker for these markets at this time too. So lots to think about.
Yeah, and you saw Powell soften his language, right? So the Fed has softened their stance for the first time, really, and that he's the king hawk, right? So it's good to see them softening the tone a little bit. But overall, I think we are still cautious on markets, and we're very cautious on global trade being a catalyst. So we think what's being priced in right now in this correction is really just global trade risks starting to be priced in the market because they're actually affecting supply chains now.
And the two of you, please do not take it personally. We're on the lows of the day now. The Dow now down 632 points. Julia, when you look at everything that's out there right now, we're talking about growth slowing. Certainly, there still isn't talk of a recession. What is this impending doom that some people seem to know something about, but apparently hasn't actually been starting to be priced into the market? And it's that oil price, right? You look at the dip on oil, and it really tends to be a global slowdown.
Okay, so I think we have to separate what we're seeing in markets from the fundamentals here, particularly for the US economy, and that has played a leadership role in terms of the underlying growth metrics, and I do think that's important. I think we're finally, as Ben was saying there, acknowledging that there could be bigger trade risks here, particularly if we see 25% tariffs implied in January, and that's really, I think, starting to impact investors here too. But I think we have to bring it back to the fact that, you know, this is a holiday week. It's Thanksgiving. US markets are going to be shut for a day and a half this week. And I think for investors, even in the really, really short term here, do you want to be sitting on, if you're a short-term trader in particular, do you want to be sitting on risk or holding stocks at this moment with a holiday for a day and a half? Right. Bear that in mind here too.
And Ben, Julia's really getting to the nitty-gritty of this. Not only are we talking about this holiday week, but we are also just a few weeks from the end of 2018. And it's important that a lot of people want to show that end of 2018 in the positive and not in the negative. What do you do? It seems like there's nowhere to hide here.
There's not many places to hide. I mean, we're looking at potentially putting on some more shorts. We haven't put on any shorts yet. We have a quantitative indicator that says, you know, when the market's going to take what we think is a bigger leg down. Right now, it's teetering. It's right on the edge. So it's saying we're at a point, a very decisive point for the market, and the market's on the fence currently about which direction it's going to head.
How important is it here as well that we keep trying to bring it back to fundamentals, but there are players now in this market in serious size that don't make choices based on fundamentals. They make choices based on price action. So when the market's going up, they buy. Market's going down, they sell. That's a huge driver too of the oscillations that we see in not just in stocks, but in other markets too.
Yeah, that's right.
Oil.
So we're fundamental investors at Event Shares first and foremost, but as a portfolio manager, I've gotten more in tune with the technicals just because of how important it is to watch the technicals. That's what the quants are doing, the algos, the systematic traders, whatever you want to call them. The computers are trading, they amplify moves. So when we have a big down move, they pile on. And the first down move, we think, started kind of in June time frame. It wasn't really January, February. It was really June. We saw rotation occurring. We saw some hedge funds de-risking. We saw them taking risks down. Instead of running 200 long, 100 short, they took it down to 150, 75. So they cut their risk pretty massively, and the quants pick up on that, and they pile on that trade.
Julia, my finance prof always told me that, look, the market's like Vegas. Don't ever mistake it for anything else, okay? And the point here now, to make that point, when we see those fundamentals, perhaps we get good news on trade. Maybe we start to see global growth and U.S. growth looking better in 2019. At what point, what is going to settle this market down? Is it the trade issue that we're going to have a trade meeting really in 2 weeks?
I think you're the right person to ask this question because I would make this point and have been all day. Silver linings. There is a lot of bad news baked into the cake here. What catalyst, as you said, Jay Powell actually just starting to soften the tone a bit too. If that happens, if we get some kind of breakthrough on trade, for me, these markets look right to be, you know, toes back in there, dip your toes back in.
That's probably the right way to think about it. I mean, being contrarian usually is the most rewarding play to trade, right? So people are all of a sudden very bearish on trade. We were bearish, months ago, and now we're seeing it play out. And we're like, this is the biggest risk for markets. Yeah. If the trade breaks down, that is the biggest risk for markets.
And final word to Ben before I let you go. How much can the Fed mess this up if they tighten too much in 2019?
I don't think the Fed wants the blood on their hands for the next recession. So I think they're going to be very thoughtful and look at the markets and see what's happening in equity markets and look at bond markets and use those indicators. And as we saw, Powell's changing the tone based on live market feedback.